Warren Buffett once said that when he passes away, the money he leaves for his wife should not be put into a hedge fund or some other investment strategy. He said it should simply go into an index fund. I've seen it all. For nearly 25 years, I worked at the DOJ, where I investigated some of the largest antitrust cases in the country. Now in retirement, I'm working for you. Welcome to the Antitrust Insider. Today, we're going to explore why index funds are the simple secret behind the wealth of billionaires and why they just might be the smartest way for everyday people like you and me to beat a system that is designed to siphon away our money through endless fees and complexity. Remember, I'm not a financial advisor, and this video is for information purposes only. Segment 1. What exactly is an index fund? An index fund is pretty simple. It's a type of mutual fund or exchange-traded fund known as an ETF that is designed to track a specific segment of the financial market. The most famous example of that is the S&P 500 index fund. This means that if you buy shares in an S&P 500 index fund, your money is automatically spread across the 500 largest companies in the U.S. Companies like Apple, Microsoft, Amazon, Google, Johnson & Johnson, and hundreds more. Think of it this way. Instead of trying to guess which single stock is going to soar, an index fund allows you to buy a piece of the entire basket. You're essentially betting on the performance of the overall market rather than trying to pick winners and losers. Because the index fund is designed simply to mirror the index, whether that's the S&P 500, the total U.S. stock market, or even international markets, it doesn't need expensive teams of analysts making guesses about the future. There's no secret trading skill and no high-paid manager trying to outsmart the market. The fund tracks the market, period. And that simplicity is exactly what makes it so powerful. Over the long term, markets tend to rise. There are bumps, crashes, and scary headlines along the way. But if you zoom out over decades, the trend line always points up. An index fund simply allows you to capture that upward movement without friction. This is why index funds have become the backbone of wealth building for people who play the long game. They give you broad diversification, meaning your risk is spread out across hundreds or thousands of companies. And because they don't require active management, they come with extremely low fees. And those low fees are where the magic really happens. Segment 2. Why index funds beat the pros. Now let's turn to the real question. Why do index funds outperform actively managed funds? The ones run by professional managers with research teams, expensive technology, and decades of experience? It all comes down to the fees. Every actively managed fund charges you for the privilege of letting their professionals try to beat the market. That fee might look small on paper, maybe 1%, maybe 2%, but compounded over decades, it quietly but consistently eats away at your wealth. To illustrate this, let's imagine two investors. One puts $10,000 into an index fund with a fee of 0.05%, which is common for funds run by Vanguard or Fidelity. The other puts $10,000 into an actively managed mutual fund with a fee of 1%. Both investors earn the same average return from the stock market, let's say 7% annually.
5 minutes later.
After 30 years, the index fund investor ends up with about $76,000, while the actively managed fund investor ends up with around $57,000. That's nearly $20,000 lost to fees. Those high fees might be worth it if most managers consistently beat the market, but study after study shows that they don't. In fact, the SPIVA report, which measures active fund performance, routinely finds that about 80 to 90% of actively managed funds underperform their benchmarks over long periods. That means the vast majority of these expensive funds are charging you more money to give you worse results than the simple index fund. Even the managers themselves know this. Warren Buffett once made a famous bet. He wagered $1 million that over 10 years, an S&P 500 index fund would outperform a collection of hedge funds picked by a professional manager. The index fund won by a landslide and returned more than 125% over that decade, while the hedge funds came in at about 36%. So when you hear about Wall Street geniuses or see glossy ads for funds promising superior returns, remember that the odds are stacked against them. Markets are extremely competitive, information moves instantly, and any advantage is usually fleeting. By the time you've heard about the next hot stock or the next hot manager, the opportunity has probably already passed. Meanwhile, the index fund just keeps quietly chugging along, collecting the returns of the overall market year after year without the drag of heavy fees or bad bets. It's not flashy, but it works. Segment 3, Fighting the System with Index Funds. Index funds are one of the simplest, most effective ways to fight back against a financial system that thrives on fees and complexity. Wall Street makes money by convincing you that investing is too complicated for regular people to handle. They want you to believe that you need an expensive advisor, a manager, or access to exclusive products. Naturally, all of those things come with an extra cost, and those costs over time siphon away wealth from everyday people. Index funds cut out the middleman, and they let you invest directly in the market with rock-bottom fees. They give you broad diversification without the need to spend your nights researching which stock might pop tomorrow. And they tilt the game back in your favor because you're no longer playing Wall Street's fee-collecting game. The idea of fighting back against a system designed to exploit you doesn't just apply to Wall Street. It applies to healthcare, insurance, government, and corporate bureaucracy. This is exactly why I wrote my second book, How to Beat the System. It takes my DOJ experience and gives you the step-by-step playbook to fight bureaucratic gaslighting, force accountability, and stop being worn down by complexity. Grab your phone and scan the QR code on the screen or check out the link in the description. This is the best way to support this channel and learn how to force fairness in every part of your life. This doesn't mean that index funds are magic or risk-free. Markets can go down, sometimes dramatically. But if your time goals are measured in decades and not in days, the historical record is clear. Holding a diversified, low-cost index fund and adding to it consistently is one of the most reliable ways to grow wealth. It's worth remembering that some of the richest people in the world, from Warren Buffett to Jack Bogle, the founder of Vanguard and the father of index investing, built or preserved massive fortunes by leaning on this very strategy. Billionaires might own companies, real estate, and private businesses, but when it comes to their passive investments, they overwhelmingly trust index funds. Segment 4, Final Thoughts. Bottom line, the power of index funds isn't based in some hidden complexity, but in their simplicity. They prove that you don't need to outsmart Wall Street to succeed. You just need to avoid paying unnecessary fees. The simple choice is often the best choice, and when it comes to investing, the simplicity of index funds can build wealth quietly, steadily, and efficiently while protecting you from a system that would rather keep you confused while you're paying a steady stream of fees. So the next time you hear about the latest hot stock tip or the next fund manager claiming to have unique skills, remember what Warren Buffett said. For most people, the best path is simply to buy and hold a low-cost index fund. What are your thoughts? Comment below. If you found this video helpful and informative, please hit that subscribe button, like, and comment. Until next time, stay vigilant, stay honest, and come back for more Antitrust Insider.